Day for global taxation, the OECD has put together its final report on BEPS. So from TPP at the start of the show now on to BEPS. What are the implications? Joining us is Menaka. Menaka, take us to the highlights of the report and then I'll come to you about the implications for India.
Well, Shireen, the BEPS or Base Erosion and Profit Shifting Project is an attempt essentially in simple English to curb tax avoidance. Here's one example of profit shifting. The OECD says that MNC affiliates report higher taxes in lower tax jurisdictions. That's in countries that have lower tax rates. So almost double of the taxes that they report in higher tax jurisdictions. So essentially, you're moving profits from higher tax jurisdictions to lower tax jurisdictions. Here's another data point. The effective tax rate paid by multinational corporations is estimated to be between 4 to 8% less than the tax rate paid by companies that have only domestic operations. Now, OECD estimates that the revenue losses from such base erosion and profit shifting are between $100 to $240 billion annually. So that's between 4 to 10% of global corporate income tax revenue lost because of what is known as BEPS. Hence, in 2013, the OECD initiated this project by outlining 15 action points against BEPS, and today it has released reports that provide guidance and new standards on these 15 action points. Today's reports cover a range of issues from tax challenges of the digital economy to hybrid mismatch arrangements, effective CFC rules. They also cover inappropriate treaty benefits, the artificial avoidance of permanent establishment. They cover more disclosures as well as a multilateral instrument to modify bilateral tax treaties. They're comprehensive reports running into thousands of pages. Shireen?
Well, Menaka, that was as far as the highlights of the report itself, but take us to the implications for India specifically.
Well, all corporations, including Indian companies, will now have to learn to live with more disclosures. So at the local level to the tax department here, as well as on a country-by-country breakdown of revenue and profit. That kicks off in 2016. So more disclosures is now a given for companies across the world. But for a more detailed analysis of the impact, let's talk to Sanjay Tolia of PwC. Sanjay, good evening. Let's start first by asking you to list very quickly the key areas of impact for Indian companies as well as Indian multinationals.
Yeah, thanks, Menaka. So I think the biggest thing for Indian companies is that clearly governments all around the world will be able to look at the big picture of the total value chain of an Indian multinational company. And I think the most important thing to note through the CBC reporting, which is country-by-country reporting, is that substance will come to the fore. So let me just give you an example. So in earlier days, if one was able to transfer risks through contracts, so contractual transfer of risk is something which is going to be totally discouraged through this BEPS program. And what will become important is that people who assume and manage those risks are going to be the people, are going to be the locations where the profits will be attributed. So contractual transfer of risk is going to be discouraged, and I think the place where the value is created is going to be the place where the profits will be taxed. And second thing, more for Indian companies, very relevant, is Indian companies doing business in foreign countries, specifically the common law countries where we had these commissioner agreements. And commissioner agreements are situations where a particular company could enter into a contract on its own account, but on behalf of the foreign principal, let's say, for example, India. So commissioner agreements were used to argue that there is no taxable presence and accordingly there is no profits attributable in that country. But with this new rules on permanent establishment, this commissioner arrangements will no longer be regarded, and in a place where a company is doing conclusion of contracts, that's the location where it will be deemed to be having a taxable presence.
So Sanjay, what you pointed out for me is country-by-country reporting, the enhanced focus on substance, and the provisions to prevent the artificial avoidance of permanent establishments. Three big impact areas for Indian companies. A quick follow-up question on that. There are also provisions for the prevention of tax treaty benefits in appropriate circumstances. Now, The Mauritius Treaty has been a big thorn in India's side for a long time now. I know that we have renegotiated it, but would it be politically much easier to apply what the OECD is suggesting, both as general anti-abuse rules as well as special anti-abuse rules, to ensure that there is no inappropriate granting of treaty benefits?
So OECD talks about minimum standards for bilateral agreements, and OECD also in its webcast today gave an example of US, that US has used most of the minimum standards for anti-abuse in most of these bilateral treaties. Countries which have not been able to have those minimum standards, which has led to double non-taxation, are expected to bring that in their arrangements and bilateral agreements with other countries.
That would include
and I think
India?
the multilateral agreement, that would include India, because India is part of the G20 who initiated the OECD. So we'll have to wait and watch that how India brings some of those minimum standards in its own treaties.
Okay, you spoke of double non-taxation. Let me talk about some of the concerns that companies have had with these OECD action points. One is the privacy of data and country-by-country reporting, and the other is the fear that with all countries getting more aggressive, you could in fact end up with double taxation. Do you think that's what this BEPS project will lead to?
So very interesting comment was made by the OECD today in the webcast that we don't want to go from one extreme to the other, which means we don't want to move from double non-taxation to double taxation. We want to stay at fair taxation. So I would expect that we don't move from one to the other, but remain at fair taxation. The second point, very interesting, is that privacy is the concern of most of the countries, because when you give the global value chain on a piece of paper, it's available to most of the tax jurisdictions. The way I look at it is that the transparency will be something which will be available to the tax authorities and tax jurisdictions around the world. There are going to be mechanisms of how these country-by-country documents are going to be shared. The way to look at it from a multinational let's take an Indian multinational standpoint, is that if the country-by-country reporting data is used to make certain adjustments, and those adjustments can become public. So that is the point in time when, if there are large adjustments which is a result out of this country-by-country report, then those adjustments could become public, and it could have its own reputation risk. So I think that's the part which a multinational company should be worried about, rather than documents being available to various tax jurisdictions.
We've got a final 20 seconds to go, so I'm going to ask you for the timeline. None of this, Sanjay, is going to happen tomorrow, day after, or next week. Even the multilateral instrument to amend all bilateral tax treaties is going to take about a year. So this impact, change in global taxation, is going to play out over the next few years, fair to say?
OECD has a very ambitious plan. So OECD is talking about achieving the multilateral agreements by 31st December 2016. So that's the expectation. We'll have to see how the countries get together. I understand that India is obviously participating in this program very extensively. So things which will have to move through treaties will probably have to rely on this multilateral agreement, and things which, action plans which can be implemented through change of rules in the domestic laws, for example, country-by-country reporting, I expect that to happen immediately in 2016. So most of the countries have already adopted CBC by 1st January 2016. Maybe because India's tax year is April-March, we should expect CBC documentation implemented by 1st April 2016.
All right, Sanjay, thanks very much for joining us. Shane, I'm going to toss it back to you with a quick comment. You've heard of tax adventurism, tax terrorism. Well, get ready for tax trauma. No fault of the government, but more news coming in from the tax space over the next year or two as all these rules change, align and adapt.
All right, Menaka, thanks very much for taking us through what this means for India. And the team at North Block said that they were looking forward to hearing from the OECD. Now that we do have the details, we are awaiting the government's response.